Hey everyone, my name is Daniel and welcome back to another video. I hope all of you are having an absolutely phenomenal day out there. As always, here today, I want to take you all through my full fundamental analysis of HIMS stock, a very interesting growth opportunity in the telehealth and pharmaceutical space that in my opinion has massive potential from a 3 to 5 year time horizon. In this video, I'm going to take you all through exactly what the business model of HIMS is, take you through their financials, valuation, and long-term price targets, as well as exactly what I'm doing with HIMS stock in relation to my overall portfolio moving forward. So if you end up enjoying this video and potentially even finding some value in it, please consider subscribing. And with that out of the way, let's get into the video here. So first and foremost, what does HIMS do? Well, they're a pharmaceutical company that also tie an aspect of telehealth into their business. Now, the products that they offer are generally under the category of things that make people feel a little bit uncomfortable. And that's the niche that they found that's made them very relevant over the past few years. Products like sexual wellness, hair loss, anxiety and depression, dermatology through skincare, and much more. Products that people may feel a little bit uncomfortable going to their doctor and asking about. Now, the way they combat this is by allowing you to actually see a doctor through the HIMS platform, pay whatever it is, 40, 50 bucks for a session, and say, hey, this is the problem that I got. The doctor's going to take a look, say if you need potentially some form of prescription. If so, you got it, you buy stuff from HIMS. And it's all kind of solved within this process. Now, the way they hire these doctors, they are independent contractors with a very Uber-style business model in the sense that these doctors get paid for however many sessions that they do. And the HIMS business model isn't reliant on, when you look at it, it isn't reliant on taking a cut of the money that's paid to these doctors. Actually, all of that is pretty much given back to the doctor to keep those costs low. Their money is coming from these products, which have ridiculously high margins, and we're going to take a look at those in a moment. But that's generally speaking what their business model is. People come here, people see their products, set up a meeting with a doctor online, potentially get something prescribed, and sign up. Or not sign up, but potentially purchase a product or potentially even subscribe to it and get it shipped to them on a monthly or quarterly basis. Now, it's not just HIMS. They also have a female side of their platform here with forhers.com. Again, feel free, go onto Google, search these up, kind of, take a look at them. But again, generally focusing on these fine categories: dermatology, hair loss, mental health, sexual wellness, and a variety of other supplements. That's something they've been getting into a little bit over the past little while here, but you kind of see a trend here. Products that people feel uncomfortable with, and over the longer run, they plan on expanding into much more than just that. So when it comes to the actual business model, a lot of positivity. Rob Gronkowski, also one of their brand ambassadors. So great to see. I like the business model. Now, the next question we have to ask ourselves is, how strong is this company's financials? Looking at their balance sheet, looking at their revenue, looking at their profitability. Well, this slide right here actually says a lot. And the most important thing that I take from this is the fact that this company gets a majority of their revenue from subscriptions. People signing up to get a hair treatment or to get an acne treatment on a monthly or quarterly basis. People who sign up and generate reoccurring revenue. This is one of the most incredible things out there. A customer that you acquire that will stay with you for literally years or maybe even decades to come, utilizing your product and again generating revenues and profits for your business for again years to come. That's one of the most beautiful things in the world, and that's why people absolutely love software as a service companies like Dropbox or Slack back when they were public. I love that company. People bought their products and stayed with them, generating that reoccurring revenue. That's phenomenal, and I love that with this company. Again, and I think it kind of speaks to the actual quality of their products. People wouldn't be subscribing to these different products if they didn't work and if people didn't like them. So again, that is with no doubt a testament to how good their actual products are. Again, revenue growth, 42%, 40%, 34%, 45%, 64%, high 70% here in the first half of 2021. This is a massively growing company. And looking at their expectations here over the next couple of years, they are expecting revenue growth in the 30% range, which is still absolutely phenomenal with no doubt in my mind, making them a growth company. Now, that was growth in subscriptions. Actual revenue has grown substantially higher than that due to the fact that average dollars per order has also increased substantially from $43 in Q4 of 2019 to now sitting at roughly $74. So again, across the board, growth at this company. Gross margins also have been increasing substantially. These were actually at around like 20-30% back in 2017, 2018. As they've scaled their business model, they've managed to increase this. So, with no doubt in my mind, I look at HIMS here, I look at their business model, I look at what they're doing, it's phenomenal. Now, let's go through the ticker terminal to find out exactly what their financials look like. Again, this is a completely free software to use that I found. Feel free to check out the first link in the description down below to, again, sign up, completely free to use for now. It's phenomenal, better than any free service that I've used in the past. Either way, let's go through it right here on a quarterly basis. Again, massive revenue growth over the past couple of years. Phenomenal from that standpoint. You take a look at their actual balance sheet here, which, important to see, hey, does this company have cash? Roughly $317 million in total cash and short-term investments. You scroll down here, total liabilities of $55 million. This company can pay off all of their debt. That's like you being able to pay off your home mortgage and your car loans and your credit card bills with the cash you have in your checking account, and in this case, still have over $280 million or $270 million left over to do whatever you want. The risk of bankruptcy at this company is really, really low. And I love to see that from a balance sheet perspective. Now, they have a great balance sheet, but they are unprofitable, and that is something to keep in mind. Although their gross margins are high, they're generating high levels of actual gross profit, and I think I should go to an annual basis here to visualize this a little bit better. Their operating income margins are in the red. They're spending a lot of money on advertising, getting their name out there. Again, that is one of the reasons, and one of the downsides to growth companies. Although they're growing revenue significantly, which this is absolutely incredible here, they're spending more money on marketing, but the fact that they do have a reoccurring revenue business model and the fact that, with time, these customers will pay for themselves and, then some substantially, makes me a very big optimist that they will be able to flip this into the positive over the coming next couple of years here as, again, they continue to scale their business model. So absolutely great here. Again, nothing too worrisome. I have actually scanned their latest quarterly report. Just looking at some great things there. From my understanding, they're a very virtual company in the sense that a lot of their employees do work online, which again, that's great, cutting costs. If it's not necessary, that's something that every company should be doing, in my opinion. Now, the next metric that I find very interesting, you look at Pfizer, and this is a company that competes in a very similar space to HIMS and HERS. Again, HIMS is really modernizing it, but at its core, they're generating pharmaceutical products and selling them. When we look at Pfizer, they're a very similar company in the sense that they're, also selling products that are similar to HIMS, potentially one of a bit of a competitor to them. So you look at their margins. Pfizer, very similar gross margins with roughly a 30% net income margin. That is something I actually do want to show you here because I look at Pfizer as where HIMS could be 5-10 years down the road if they do end up focusing on profitability as they, again, continue to scale their business model. But you look at Pfizer, you look at their financials, and it's actually a little bit more prominent here in this section. Their actual net income margin has been sitting at roughly 30% over the past 5 years, with gross margins, and let's go back here to actually take a look at their gross margins of roughly 80%. HIMS is at 80% right now. So you look at their actual forward enterprise value to revenue ratio, And you'll see that HIMS isn't trading at that big of a premium to Pfizer, which is phenomenal to think about because HIMS is going to have substantially higher growth than Pfizer will have over the next 5 years. HIMS is smaller, got much more growth ahead of them. And this kind of shows me that, hey, even though this company's not generating a strong profit at this point, their stock probably isn't going to go in a major decline if we do end up going into a bear market, as again, we kind of have already seen that with its price performance. I think it actually hit a peak of roughly $25 back at the beginning of this year. Kathy Wood from ARK Invest actually bought this stock at one point. Not sure if she still holds it, but again, that's a testament to the company and what they're planning on doing. So that's the business model. A lot of phenomenal things going on here. And again, if you look at analyst estimates, 27% revenue growth expected in 2022. Now, they were actually guiding for 30% in 2021 and 30% in 2022. They beat that estimate in a major way. Expected 70% revenue growth now in 2021. So you look at this number right here, I think this company's easily going to achieve 30% revenue growth, if not more next year, which leads me to my next point. Let's go through my numbers. Where do I think HIMS stock could be from a 5-year time horizon? Obviously now the end of 2021, so I'm not really going to count that. But looking out to 2026, what is the potential of this company? Again, expected roughly $254 million in revenue in 2021. I'm going to expect 30% revenue growth in 2022. I do think analysts do have that off, at least at this point, and there's nothing really signaling that they're going to miss in a massive way, and especially given that international expansion is on the horizon for this company. And then I do have revenue growth slowing down over the next 4 years, just to be a bit conservative here, leading us to have roughly $770 million in revenue by the end of 2026. You look at net income here, I do think over time they will scale into something much more similar to Pfizer. I think this company, even if they are spending money on advertising, will be valued very similarly on a price to sales ratio, at least in comparison to something like Pfizer, if not obviously even more, because they are a growth company. So I do have 25% net income margins here by the end of 2026. Again, Pfizer does have a 30% margin. So given that their gross margins, cost of, actually revenue minus cost of goods sold sits very similar in comparison to Pfizer, I don't think 25% is that unrealistic. So I'm going to assume that. We'll see if it happens. I do think that's a longer term goal for them, or at least the market will be valuing them based off of that. You have the current valuation here, $8.33 per share, multiplied by a fully diluted share count of 203 million, giving us a market cap of just around $1.7 billion. Got some different PE ratios here, 20 to 30. They are growing and will continue to grow for the coming decade, giving us upside of anywhere from 130 to 240%. And you do have a 5-year CAGR right here, just to kind of visualize that a little bit further. So I look at what's going on with HIMS here. It's a very intriguing opportunity. And you got to understand, this company is just starting. The innovation here in terms of product launches is phenomenal, and in my opinion, will easily drive this growth for years to come. So we'll see what happens, but this company pretty easily meets my expectations and criteria for a growth stock over the coming years, and with the potential to outperform if, again, these revenue growth numbers may very well be a little bit conservative. So I look at all of this. I'm optimistic, and I see a lot of potential here with this company, which is why it currently makes up, and I do have it on my phone here, 2.59% of my overall portfolio with a cost basis of $7.48. Now, personally, I do prefer this stock under $8. Now, over the next couple of weeks, couple of months, I'm fine building this up to potentially a 5% position. Now, they do have earnings this upcoming Wednesday, and given that their business model is relatively stable, I do see potential for this company to potentially turn around in a major way when they do report on Wednesday. So I may actually end up buying over $8. $8 is kind of that level that I want to buy under. But hey, if it's trading at $8.10, $8.20 with earnings coming up on Wednesday, I may bump this up to a 3 to 4% position before that happens. But anyways, guys, thank you all so much for watching this video. I really do appreciate it. If you found some value in it, please consider subscribing, and I will see you all in the next one. Bye-bye.